Very good morning to all of you today. And I must say, I thank all of you for taking time on a Monday morning and being a part of our event today. And the event is titled Financing Early Stage Businesses Beyond Venture Capital. It started by my interaction with Mr. Ambrish Datta, who is the heads the BSC Institute, which is Bombay Stock Exchange Institute. And this happened in Hubballi, which was a very interesting place to have met him, because as some of you know, Desh Deshpande, who is a big, part of what IIT and IIT Innovation Ecosystem does. This is his hometown, and the kind of innovation ecosystem that they're building there is amazing. And so we were a part of a small, symposium there, and we got chatting. Started chatting, and I said to him that most of our startups and would-be startups are looking at only one type of financing, and that one type is venture capital type of funding. I mean, it could be in the form of angels, it could be in the form of other forms, but primarily the outlook is to get venture capital funding, and to some extent, the degree of success also seems to be defined by the fact that you have some venture capital funding, which validates your business plan and ensures success. This seems to be the school of thought. Often, certain fundamentals of business is not accounted for in this thought process. And particularly, if people can just mute themselves, that'd be great. And particularly, what is important to understand is businesses are successful when they make profits, not necessarily when somebody puts money into their business. What is not also recognized is when a venture capital company, firm, or a person puts money into you, he or she is also putting money into 25, 30, 40 other entities. And their goal is that only a few of them actually become very big success. And that is the ratio in which they are working. So just because your company is funded is not an assurance that your company will be successful. In fact, if you look at the track record of any venture capitalist, you'll see that the success rates are rather modest. Also, you must understand that when you are, subjecting yourself to investment by a venture capital, you are giving a part of your company. At early stages, this may not look very expensive, but much later, you will realize how expensive the cost of investment is to the company. So often, it is prudent to take into account this alternate school of thoughts. Look for alternate mechanisms of funding in addition to venture capital. So while venture capital funding has certain advantages, you must also recognize that there are better ways of funding or alternate ways of raising capital. And kind of that is the topic that we're going to talk about today. So today we have two gentlemen from BSC Institute, I believe, or at least representing that institute. And the person who is probably going to be presenting today is Vikrant. And just a brief about Vikrant is he's the founder of an organization called Fund Enable, which helps startup founders in raising capital. So this kind of many of you are very, I'm sure, eager to hear from him, and helps you to access investors and close funding process itself. His platform has about 2,000 subscribers, raised about 200 crores of funding for tech ventures alone. Some of the recent success stories are 12 million for Work India, job platform, 4 million for eMotorrad, Pune electric cycle startup. Just want to let Vikrant know that we have quite a few of cycle startups in our ecosystem also. Okay, most of them are e-based. It works with about 50 marquee incubators. And prior to Fund Enable, Vikrant has investment banking and venture capital experience. So, and worked with JP Morgan, Springboard Ventures, among others, and has been working in transactions sectors across domains such as consumer, healthcare, technology. He's a visiting faculty at Venture Capital and has also looked at participating in several programs at IMB, NRS, NSR Cell, SPII, MR, XLRI, Exceed, and many others. Okay, so he was also a speaker at the CNBC Startup Nation and has completed BTech from Sardar Patel Institute of Technology, MBA from BSc Institute. So he's homegrown with BSc Institute. And as part of what's called the Cornell Maha 60, which is a funded program for 60 selected entrepreneurs by Cornell University. He's also pursuing his PhD at Venture Capital today. So with that brief introduction, I would request Vikrant. Vikrant, please go ahead. I would say, if possible, the whole program is for, I think, 2 hours. So if you could give, enough time towards the end for us to chat with the participant, that'll be great. Thank you.
Definitely. Thank you, sir. And thank you so much for inviting us to conduct this program. And what I'm going to do is I'm going to just start sharing my screen so that I can take you to the deck. Great. So sir has already given a very quick introduction. I will just quickly introduce myself to begin with. My name is Vikrant. I founded a startup, a company called Fund Enable around 6 years ago after exiting a business in the asset leasing space. And Fund Enable predominantly is an investment bank that works with early stage businesses like yours and helps them in raising growth capital, right? Whether it is equity, whether it is alternate sources, which I'm going to discuss today in detail. Some of the transactions, I will take you through it. We raised 24 crores recently for a company called eMotorrad, which is an electric cycle company based out of Pune. We've raised 5 rounds of funding for this company called Work India, which is a Bangalore-based blue and gray collar jobs platform. The recent round, which was raised, was a $12 million round with a bunch of investors. And there are marquee investors like BNext, Asuka Global, etc. as a part of this company. I sit on the seed funding committees of almost 17 incubators in the country today and work with almost 50 incubators, where there are a lot of funds which are available like SISF, Nidhi SSP, various state government schemes which are available. And those funds are actually given to startups. So that entire process flow for various incubators is managed by my company. And very interestingly, I've got this great opportunity to train CEOs of incubators through a special program by SIDBI, who are now supposed to invest in startups through various funds. So I've personally trained more than 90 incubator CEOs on how do we deploy funding, how do we set up the process, how do we kind of ensure compliances are in place, reporting is in place, etc. I've been very fortunate to be a part of this program by Cornell called Cornell 60, which is a fully funded program by Cornell for only 60 founders. And it's management and entrepreneurship. And a lot of my, I would say, connects, investor connects, founder connects, I attribute to this one program per se. I spend almost 7 to 8 days in a month teaching across various institutions. The course that I'm going to take you through actually was tried and tested at IIM Bangalore, which I'm going to talk about today. And, right from I'm Ahmedabad, CI, SPJMR in Bombay, I take up a program. I visit EDI, Entrepreneurship Development Institute of India. The only topic that I know is capital raising. And that is what I'm going to bring to the table today as well. While I'm teaching, I'm also learning. I'm pursuing my PhD right now, and research is again in the area of equity fundraise and venture capital. I run a show on CNBC called Startup Nation, which is all about challenges of startups. How do we address them? My part in the show is to kind of talk about fundraising as a challenge and how do we actually overcome that. And sir mentioned, or he said the context in terms of we are all looking at equity fundraising predominantly. Everyone is focusing as early stage businesses on equity fundraising, but capital raising goes beyond looking at equity, even for early stage businesses. And how do we actually, put across or cover various sources of capital, look at it, evaluate, select, is what I'm going to actually discuss today in detail. And by the end of today, each one of you will have a very detailed understanding of all the sources that are available for us as early stage ventures when it comes to capital, and which one to choose for you, for specifically for you, which is the one that we should go ahead with and what are the next steps. So that's the overall objective of today's discussion, right? So with that, I want to begin with, understanding capital a bit, and we'll start with the basics. All of us know capital is the bloodline of the business. We need capital, but why do we need capital? Capital is required for two primary reasons. One is for scaling up initiatives, right? And the other is for short-term obligations, right? All of us understand the difference between two as business owners, that one, I want to expand, I want to hire a team, I want to possibly set up a manufacturing unit, I want to develop technology which will actually be good for thousands of people, right, in one go. So all of that comes under scale-up initiatives. And then capital is also required for short-term obligations. That, hey, you know what? I have raised an invoice. Okay, the money is going to come after 90 days, but today I need some money to run my operations, right? So what we call as working capital. And as early stage founders, we also need money for both these, I would say, initiatives, right? Short scaling up initiatives and short-term obligations. Let's now deep dive into each of these two and understand what all sources are available and how do we actually address these, right? So first, I'm going to double click on scaling up initiatives, right? And this is very interesting to understand, guys. Scaling up initiatives are actually of two types, okay? You can scale up in two ways. One, when you're scaling up is P&L driven, okay? Where your scale up is entirely driven on or driven by your profit and loss account. And second is your entire scale up is driven by expansion of your balance sheet. It's very, very critical to understand this because the sources of capital change as per these two different ways of scaling up, right? What do I mean by scale up is driven by P&L and scale up is driven by balance sheet? What do I mean by that? Let's say the reason why you need capital is for improving your product, is for hiring talent, is for marketing. Okay, why do I need money? I need money for building my product. I need money to hire more people. I need money to spend on Facebook, Instagram, or to spend on advertising, to spend on customer acquisition. If your capital requirement is predominantly this, right? Which, by the way, in most cases for startups, this is how it is. But if your capital requirement is predominantly for developing product, hiring people, acquiring customers, then these are all cost items sitting on your P&L statement, right? Profit and loss statement, all of us know, right? On your P&L statement, these are nothing but cost items, right? Which means what? Your expansion is driven by spending more today. Your expansion is driven by actually your P&L. Everything when it comes to your expansion is sitting on your P&L line, right? Today I have to hire people and spend on manpower. Tomorrow they will perform and bring me revenue. Today I have to develop product, make an expense. Tomorrow my product will be ready and it will make revenue. Today I have to spend on customer acquisition. Tomorrow my customers will come to the platform and pay me, right? So you are essentially front loading your costs on your P&L today. And that is why, and that is how you are actually expanding, right? Such kind of expansion is called as P&L driven. There is another way of expanding. What is the other way of expanding? I want to set up a manufacturing unit. I want to buy more equipment. I'm developing an electric cycle. What I want to do is I want to set up a small unit where I can manufacture, I can assemble, and I need some machinery, right? And my entire expansion is driven by setting up a manufacturing unit and setting up machinery. Now, where do these items sit on your three statements of finance? These three items, or these two items, which is manufacturing, machinery, all of these are nothing but assets on your balance sheet, right? These are not your costs. In finance, we don't book capex as cost. We just attribute a very small element of it, which is depreciation through the P&L, right? But predominantly, all of these items are sitting on your balance sheet as assets, right? So if your requirement of capital is predominantly for expanding your manufacturing facility, for setting up a manufacturing facility, for buying up some equipment or machinery, then your expansion is balance sheet driven. Your P&L is not going to be impacted by it, right? This is the second way of actually expanding, right? A particular venture. Now, who funds what is very, very important to understand. Always remember this. If your expansion is driven by your P&L, then the source of capital that you have at your disposal is actually VC money, right? Venture capital investors fund the costs on your P&L. Predominantly, they will fund the costs on your P&L, right? You go to a venture capital fund and say that, hey, you know what? I need money for hiring. I need money for technology. I need money for marketing. Will I get money? Yes, you will get. You go to a VC fund today, a lot of these battery startups, EV startups, which are focused on actually creating capacity. When they go to VC and ask for money for basically, when you ask for money for creation of assets, you will not be able to get money from them, right? The reason why this happens, I'll come to that, but first understand that VCs fund costs on your P&L, right? And that is the reason where if your expansion is driven by P&L, then it is very important to understand this, okay? If your expansion projected P&L, your next year's P&L, whatever you showcase as projections, will actually have a negative element or a negative EBITDA or a burn, right? You will be loss making. There is no other way but to show a loss in the next year, because predominantly to fund that loss, you need money. Now, why is the loss happening? The loss is not happening because your business is not doing well. The loss is happening because you're expanding and your expansion is predominantly sitting on your profit and loss statement. So what happens when people come to ask for money from us for marketing, manpower, etc., and the next year, very next year, they are showing a profitable P&L. And then the question that we have for them is, if you are profitable, which means your revenue is taking care of your costs, then why do you need money? Why are you coming to us for money, right? So it is important to understand that if your P&L, if your expansion is driven by P&L, then your projection will have EBITDA burn. And the burn is nothing but the sum of the burn for 18 months is nothing but the fundraise requirement that you have if your expansion is fully driven by P&L, right? So monthly, when I'm making monthly revenue, right? Monthly revenue assumptions, monthly cost assumptions I'm making. Hey, this is my revenue for estimated months. These are my costs, marketing, manpower, technology, etc. And every month there is a small, tiny burn which is there. A round of capital that I need is nothing but the sum of these negative EBITDAs for a period of 12 to 18 months. So when I sum up these negative EBITDAs for a period of 12 to 18 months, or sum of losses for a period of 12 to 18 months, that is the kind of capital that I'm actually asking from the investor. Again, the loss is not because my business is not doing well. The loss is because I'm front loading the costs so that I can get the benefit of it maybe 2 years later, maybe 1.5 years later, right? That's the crux of this whole, which source of capital, where to raise from, right? Now look at the other side. What happens is when your expansion is predominantly driven by manufacturing unit or machinery, that is what you're asking for. Typically, banks will fund your balance sheets. Typically, the source of capital for you in this situation predominantly is not venture capital. It is actually debt, because your balance sheet driven expansion, your asset driven expansion is funded by banks per se, right? So the prime difference, so what will be the capital requirement in this case? The capital requirement in this case, like in the first case, the capital requirement was the sum of negative EBITDAs. In this case, the capital requirement is nothing but the sum of capex. That, hey, I need 6 crores for setting up a factory. I need 2 crores for buying machinery. So the total funding that I need is somewhere around 8 crores, right? Always remember, your EBITDA in this case can be positive from year one, because you do not expense out your capex on your P&L. So when you're showing projections and your expansion is driven by assets, right? You can be still positive in the very next year, right? That is fine. That's okay. People will not ask you questions, right? That is the reason why it becomes very important for us to understand this question that, hey, you know what? When SMEs expanded, they were always profitable. But when startups expanded, they were always loss-making. What was the reason? When SMEs expanded, their expansion was driven by their balance sheet. Their P&L was not getting expanded, or was not getting impacted. But when startups are expanding, their expansion is driven by the costs sitting on your P&L, and that's why they seem to be loss-making, right? And that's the difference between the two. On what factors is the decision based? How do we make the decision? On what factors is the decision made? When it comes to giving you equity fundraising, I'm not going to discuss too much on this, but when it comes to giving you equity fundraising, or when it comes to raising money in the form of equity, this is the factor. These are the factors basis which the decision is made, right? And you can take a screenshot of this, snapshot of this. I can also share my videos on this particular topic, which is funding matrix, that on what basis VCs define or determine whether I'm going to invest in your business or not, right? I will share a video on this post this session. There are various factors. What we've done is we've studied all the deals that we did over the past 8-10 years and created a pattern in terms of what worked and what did not. And there was a clear-cut pattern that emerged, and that pattern is what you're seeing here, right? So what all factors are important and how much weightage is given to each of the factors when it comes to equity raising, right? Also, in today's market, what is happening is there are thumb rules, okay? So if you are in a particular sector and if you are looking to raise a particular ticket size, then there is an expectation of an ARR and some contribution margin. What is an ARR? ARR is nothing but annualized revenue run rate. So if you're doing 2 lakh rupees per month of revenue today, then your ARR is 24 lakh rupees, right? What does it mean? Let's say you are a startup today in the agri-tech sector, right? And in the agri-tech sector, you're a startup who's looking to raise $1 million of funding, right? So I'm a startup in the agri-tech sector, and I'm looking to raise $1 million, right? What is the market expecting from me today? The market is expecting me to have an ARR of around $200K US, and not just that, have a margin, a contribution margin of 30%, right? So gone are the days when investors were investing purely basis users or purely basis, some revenue. Today, as the market dynamics have changed, people are asking, investors, even angels for that matter, are asking that, hey, show me your unit level economics or show me your contribution margins. Are you positive on your unit level, right? So every sector today has this, this whole formula in place. How do we get to know about it? Because we interact with investors on a day-to-day basis. How will you get to know about it? Again, when you hit the market, with your pitch, with your fundraise documents, etc., people come back and say, hey, you know what? We would like to wait. Come to us when you hit 100K revenue. That is the time when you can raise $1 million. Or what we can do is, today I am doing, let's say, 10 lakh rupees of annual revenue. What is the quantum that I should be raising from the investors? That can be then adjusted accordingly, right? And we can do one-on-ones later where me or my team can actually deep dive and tell you exactly that, hey, if you are a startup in the IoT space in this particular vertical and in the proof of concept stage, what is the typical quantum of capital that you need to look at, and how much dilution will happen, and what is the expectation from the investor market, right? That matrix, we can actually help you in figuring that out per se, right? But this is very important to understand. The other side of it, unfortunately, for debt, okay, the decision is based on three things. Okay, what are these three things? Collateral, operating history, and profitability. So if you need capex, if predominantly you require capital expenditure, right, which means you want factory, manufacturing, etc., the decision, unfortunately, is based on, do you have collateral, do you have operating history, and do you have profitability? Unfortunately for us as early stage businesses, we don't have either of these. Because of that, what is happening is, any startup that you see today in the country, which is dependent on setting up manufacturing or setting up equipment, is struggling to scale. Today, if you see, I visit so many incubators, right from IIT Mandi to Great Lakes down south, and I see innovative products which require capex are not able to raise that money, because VCs are saying that, hey, you know what, we fund only P&Ls, and banks are saying, I need collateral, operating history, profitability. So what do we do? How do we get out of this trap? What is happening right now is, various asset financing options are coming up through not just, I would say, NBFCs, but also through individual investors. We have started connecting with individual investors who are actually investing in assets, investing in capex, but that is coming at a cost of 18 to 24% with some moratorium. So let's say you are a health tech startup creating a device. Now, health tech, possibly the maximum gestation period requirement today in any sector that I've seen, and any, one of the most challenging sectors today is health tech, because the product needs to be developed, clinical trials need to happen, the product needs to go to manufacturing, and then you have to sell the product, right? So any device that any innovator is actually working on, especially in health tech today, is hats off, because the challenges for that are maximum from a financing standpoint. So what is happening here is, we have to bring in individual investors in the form of debt at a return of 18 to 24% with a moratorium of, let's say, 2 years. And after that, the payments will start. We can a lot of times do structuring like an optionally convertible debt, where after 2 years, we can also give them an option to convert into equity, or you can treat it as loan. And that option valuation, at what valuation, will be determined at the next round of funding per se, right? This is how convertible instruments work. But this is one way which we are using, which we are seeing a lot in the market. Fund your capex through, through individual investors at a slightly higher return, right? The other option that startups should look at is to make their business asset light. Work on the IP, work on the IP of the product. Manufacturing can be outsourced. If you have enough ways to protect your IP, if you have taken enough care to protect your IP, then if you want to be asset light, if you want to scale faster, then we have to find ways to get the product manufactured from someone else, rather than setting up our own unit, our own entity, our own machinery, etc. Many cases in terms of very new age innovation, it is not possible. But a lot of times I can see people still can set up a very small assembly unit by getting everything manufactured so that the capex requirement goes down and your fundraise requirement actually significantly drops per se, right? So what we need to, as first topic, and I'm going to take a pause after this, what we need to look at is when your expansion is driven by front loading your costs, VCs, you can look at it, right? But when your expansion is driven by building assets, you should look at debt, not just banks, but you should look at various debt options that can come in. And one final takeaway from this small topic is always remember VCs will fund your P&Ls and banks will fund your balance sheets, or debt will fund your balance sheet expansion and VCs will fund your P&Ls. I'm going to take a quick pause before we move on to various other alternate ways of financing. And I'm going to talk about a bunch of these alternate ways of financing. I'm going to take, I'm going to take a quick pause to see if you guys have any questions. Maybe you can just unmute, speak up. I can also see some questions on the chat box, but happy to address any questions if you guys have any questions. Any thoughts?
Yeah, I think you start by the first question, which is asked by Nitesh.
Sure.
The number means priority or weightage in the previous slide. I don't know which slide is meaning.
Yeah, I know which. So on the yeah, I'll just go to this slide. The number typically does not mean, to be very frank, priority or weight. It is basically the flow in which we move. For priority assignment and weightage, there is another, along with this, there is a file that I will share with you guys, and you can then get the weightage and the priority matrix also, right? Right now, look at this slide predominantly from what all is important from capital raising perspective, what all becomes extremely critical, right? Example, I will give you an example, scalable business model. Now, the reason why I want you to deep dive into this is what is our understanding of scalable business model? Our understanding of scalable business model is that the business should expand, right? There is a definition of scalability from finance standpoint. What is that definition? Let's say today your revenue is 10 rupees, okay? And for that 10 rupees of revenue, you have actually invested 5 rupees of capital. So my revenue is 10 rupees, 5 rupees of capital has been invested, right? Now let's say I want to double my revenue to 20 rupees. Do you need incrementally again 5 rupees of capital? If I actually now increase my revenue from 20 to 30, which means incremental 10 rupees of revenue, will it again require incremental 5 rupees of capital? If the answer to that is yes, even though you are expanding, your business is not scalable. So every incremental revenue requires incremental amount of same amount of capital, then your business is not scalable. What is the definition of scalability? Your first 10 rupees of revenue required 5 rupees of capital, but your next 10 rupees of revenue required only 2 rupees of capital. And after that, it fell down substantially to 1 rupee, right? That is the definition of scalability. Is your business scalable? Finance, from a finance lens, is your business scalable? Is what we need to look at, right? So these are some of the aspects which you can double click later. Right, in terms of what exactly do we look at in the team? What is a scalable business model? What is value proposition? What is a vitamin business and a painkiller business? Right, the difference, very, very important. Are you a vitamin business or are you a painkiller business? Right, this is what you can have a look at. Right, there's a question that has come from Shiv. If the funding is from a venture capital fund, then what implication does it have on ownership? If VC funding far exceeds the startup own fund, then will the ownership be taken over by VC? If not, perhaps later when net worth increases. Okay, Shiv. So this is your question is so detailed that this is a topic in itself that I teach, which takes around 1.5 hours. But let me try and kind of give you a very small, I would say, a capsule answer to this is that yes, every time you dilute, every time you give away ownership to a fund, it essentially means that your ownership is getting diluted. It doesn't mean you are giving stake from your particular, your own money, your own stake is not being given to the VC, but new shares are issued in the company. And because of that, your ownership in the business falls, right? Dilution happens. The more the number of rounds you raise, your dilution increases. At a point in time, always remember, when you raise venture capital money, at a point in time, you are an employee of your own company, you are a shareholder in the business, and you are a seat on the board. You have a seat on the board, right? The way we as founders, all of us run business right now, right? We take decisions on our own. We kind of execute things on our own. That is not how it works after you raise venture capital, right? It changes. You become an employee of your own company where you're holding some position like a CEO, CTO, etc. You have ownership in the business. You have shares in the business. And then you're a seat on the board. But there are more board members now because every time you raise a round of capital, you're possibly offering a board seat to the investors or they are asking for it. So the control sorts of starts going down. And even at an early stage, when you are, let's say 10% of shareholding has been given to a venture capital investor, there are certain clauses in the agreements, like an affirmative voting right clause, right? Which gives very good control over the company to a person or to an investor who has very small shareholding in the business as well, right? So it doesn't mean that, hey, I need to be 51% owner as an investor and then I will start having control over the company. No, a 10% investor through certain rights that are offered in the agreement can have a substantial ownership or say when it comes to the operations or matters of the business, right? So I'm going to share something with you. So I have written actually an article on your story. The title of the article is 13 Reasons Why You Should Not Raise Money, right? While I am in the business of capital raising, I have actually written, and I'm going to share it with you on the chat window. Here it is. This article I've written is to first consider whether you should be raising venture capital money or not, and what is the other side of the story. While we see everyone talking about it in the media, etc., and we are making founders who are raising money as demigods, and investors, we've already made them demigods, but it is just a source of capital, right? When an SME used to raise debt from SBI, why did they not come and celebrate? They should have also celebrated, right? They should have also put an article. It's at the end of it, it's a source of capital. I have raised 10 crores from debt. I have raised 10 crores from equity. It is actually, raising capital for expat. But somehow we've kind of in our mind made founders who have raised money as demigods, and investors are much beyond that. And there's a need to kind of zoom out, think what makes sense from a business standpoint, and choose the right source of capital, right? Great. There's a question that has come up. What is the maximum moratorium period given by the VCs? Okay. So Manoranjani, moratorium is a term which we typically associate with debt, wherein there is a certain time period which is given to you before you start servicing the debt, before you start paying interest and principal, right? Let's say 2-year period. So let's say I am a health tech startup. I need 2 years to be out in the market to start making revenue, but I need money today. So what I've done is I've taken, let's say 1 crore rupees as debt. I'm not going to pay any principal payback or any interest for a period of 2 years. And after that, I would possibly start making revenue, and then I'll start servicing the debt. That 2-year period is called as the moratorium period. The equivalent period in VC is called exit period. Exit period is, I have given you money. I've bought shares in your company. Now I'm going to wait for, let's say, 5 years before I start knocking your door and asking for exit, asking for my money, right? That is called exit time period. Typically in venture capital, the exit time period is 5 years, which means after investment, a VC fund will wait for 5 years. And after 5 years, they'll start knocking your doors. And how do you give them exit? Either in terms of a secondary sale, or in terms of an acquisition, or in terms of an IPO, where some share sale should happen to facilitate exit to the venture capital, right? I conduct this 2-day program. In fact, I was surprised. I was in Ahmedabad this weekend, Saturday, and people who are attending this workshop today had traveled to Ahmedabad to attend my 2-day program, which was conducted by the government. And that is where I discussed this in detail. The exit time period. How do we actually go about, creating an exit horizon for venture capital funds, etc. At some future point in time, I would be happy to kind of take you through it in detail, right? Great. Any more questions on this? There's one question that has come from Vivek. How does the contribution and ARR work in case of platform model, where contribution is more from customer lifetime value rather than on a period basis? Okay. So Vivek, what we will have to do, so I'll give you a bit of history here, okay? So when angels and VC investors started investing in India, back in, let's say, 2010 to 12 time period, everything was basis idea that, hey, you know what, good team, great idea, let's put in money. By 2015, people started asking questions around users. I need users. I don't care if you are making revenue. Just show that your product is used by a certain segment of people. By 2018-19, the matrix changed to customers. I don't care whether you have users or not. I want paying customers, right? And by 2021-22, the matrix changed to, I don't care whether you have revenue. Show me that you have a contribution margin, which means on every user, on every transaction, I don't care about the lifetime value. Today, a particular customer is buying a service or a subscription or a product worth 100 rupees. I have spent 60 rupees on acquiring that customer. I have spent 20 rupees on servicing that customer, which means my contribution on 100 is 10. I don't care whether the customer is going to come back, never come back, again going to come back, throw more money. Today, on a unit level, do I have a contribution margin? In this case, yes, you can say I have a 10% contribution margin, right? But if the situation was that I am actually getting the user, he's paying me 100, I've spent 120 rupees on acquiring this user, and I've spent another 30 rupees on servicing that user, which means today my contribution margin is negative. The story of this user will come back to me, keep paying me, is gone in the market today from a venture capital or a investor's perspective, right? So what we need to actually figure out is, what we need to actually focus on today is show unit level positive on day one. That is what the market is asking, right? And therefore, it is great to show a lifetime value, but even today, as on today, on unit level basis, am I throwing a positive margin, right? If you are able to showcase that, let me put it this way, the probability of raising capital for you will increase substantially, right? One last question I'm going to take before I move to the next topic. This question is coming from Nitish. If I want to raise a certain amount, say $1 million, and I don't get that amount from one VC by offering certain amount of percent, is it wise to go to multiple VCs to raise the same amount, dividing the same equity among others? Yes, Nitish, obviously. This is called co-investment, right? What is co-investing? That a bunch of investors come together and at the same terms and conditions, at the same valuation, they invest in, right? So this co-investment model is very, very famous. The question that you need to ask yourself is that, is the VC not putting in $1 million because they don't have money? Or is it because they feel you are at a stage where $1 million possibly is not the right amount? You need maybe $100,000 right now, right? So gauge that, right? There might be a situation where everyone will believe that, hey, you know what, possibly 1 million is too much for you right now. Only raise 500,000 and I'm going to put in 500,000, right? Get a clarity on that per se, right? As founders, we think that, hey, we need a lot of capital, we need more capital, and we want to raise more money. But when we hit the market, the feedback comes that, you know what, you should only raise this much right now, move to the next stage, and then raise the next round of money, right? So gauge that and then take the next step, right? Cool. So what I'm going to do now is.
Can I? I'm sorry. Can I?
Yeah.
Am I audible, Mr. Vikrant?
Please go ahead.
Thank you very much. We are from Can BRS Therapeutics. So we work on technology development for breast cancer therapy. So we are technology developers, make it or we don't make it, like that. We sell the technology to the international corporations, pharma corporations. So what type of funding? We have got the grant through the Department of Biotech and of course through complete support from IIT Madras Incubation Cell. So which type of funding will be ideal from your perspective? Of course, we wanted to generate other type of revenues like purchasing and equipment, making that equipment for serving the people to use all those things. But core, we develop the technology and then sell the technology to the international multinational pharma companies. So
Sure.
What type of funding you prefer?
So
let
me ask you this question to you. What is the use of the money? The use of the money to hire people only? Is it to hire people?
Yes, we wanted to see, it's like this. Ours is a biotech based company. So we wanted to give good amount of salary, then only we can have real quality people.
Sure.
Otherwise, it's very tricky. You know very well about that.
Yeah. So basically, your like I guess your predominant requirement is upfronting salaries. Okay,
Yes.
I need to set up a good team.
Yes.
I have technology in place. I need people to kind of work on that technology and set and create products, right?
Yes.
Let's say the gestation for that would be, let's say 1.5 to 2 years max. But by then the product will get developed and you can sell it at a great price per se, right? So in this situation, what you should do is you should talk to individuals. You should not go to VCs. You should not go to anyone else, but you should talk to 1 or 2 individuals which actually know the sector, or which will buy in this sector, or which understand this sector per se, right? And raise that short-term 1.5 year of requirement from these individuals. Now the choice is yours. Either it can be, and I will talk about revenue-based financing with you, right? Basically, when we talk about that, you'll realize that money can actually be borrowed from an individual by you, right? And the payouts can be linked to the monetization cycles that you may have, right? So in your case, you can go for both ways. You can go for equity, or you can go for money which you are raising from individuals in the form of debt for a certain time. And I'll as we move ahead, I'll tell you how.
Thank you.
Okay.
Yeah, just a quick request. Please, others may kindly mute themselves, please. Yeah, can you please mute yourself? Yeah, thank you.
Like you want to specify.
No, I think, can you please mute yourself? People who are not speaking may kindly mute themselves, please.
Sir, good morning. Sir, may I ask a
Go
question?
ahead with the question.
Just one request before that to the admin, whoever has the admin account, MUS 2012. I think that account is not.
Could they be muted, please? MUS 2012.
Okay, please go ahead with your question.
So good morning. This is Revati. I have a pre-seed stage startup at IIT Madras Incubation Cell, IIT Madras Incubator, Incubator. So we provide a solution which favors zero carbon emission and prevents environmental pollution. So we are at pre-seed stage. We are looking for funds. So what are the main points should I include in my pitch so that I can attract money? I can attract the investments from VCs or get funds from the government.
Sure.
So could you please throw a light on this topic?
Yeah. So Revati, what we will do is, if we will sit one-on-one. Okay. I will, this is slightly outside of the topic that we are discussing right now, but it is very important, right? So what we will do is, I can sit with you one-on-one, and I can actually, we can go through it in detail in terms of what you should include, what you should not. You can give us some more details about your business per se, and then we will help you in structuring the entire, pitch per se, what can be included, how you can position it, what are the elements that you should bring out, how you should weave all these elements as a story, right? What is important, one small thought, which I want to leave, what I've seen is innovators who are actually pitching, right? their entire focus is on the product. Okay. But try and understand, investors are not actually investing or not investing just because you have an innovative product. Okay. Investors are investing because the innovative product has the ability to become, so the product can be converted into a P&L, which means a 100 crore business can be created, or a 50 crore business can be created out of this innovation, right? So the pitch shouldn't be all about, hey, you know what? I have developed this product. This product is 10 times better than the competition. This is not there in the market at all. These are the 50 features of the product. This becomes a product pitch. You are pitching a business to the investor, and the business has various elements. What are the elements? Hey, you know what? There is a need for something like this in the market. I have built this product. The team which has built this product has the capability to kind of take this to the next level. You know what? Commercial viability of this product is possible. This can be the, the cost which we can get, or the price which we can get in the market. How do we plan to hit the market, and how do we kind of develop channels to sell this product, right? How do the financials now look like? So the entire pitch has to be viewed, we have to kind of weave a story wherein the product is a part of the story and not the entire story, right? So I will, I will sit with you at some point in time and give you details in terms of how do we create that, storyline, wherein you are pitching a company to the investor and not a product to the investor, right? But let's discuss this in detail, right? Great. Moving on, moving beyond, pitching and equity, etc. There are a lot of newer ways of financing that we are seeing in the market at this point in time, right? And some of the newer ways of financing, one of the best ways, which I'm seeing a lot in the market right now, so many companies have come up, is something called as revenue-based financing, or this is also what we call as non-dilutive way of raising money, right? We don't need to dilute equity when we raise money through this particular way of financing, right? What is revenue-based financing? Revenue-based financing is nothing but you are pledging a percentage of your revenue for the money that you're looking to raise. And I'll give you an example, okay? I need 1 crore. Okay, I want 1 crore. And what the expected return of this particular investor is 1.3x, which means when I invest 1 crore, at a certain point in time, 1.3 crores should come back to me, right? And what we have discussed is, we've decided percentage revenue share, which is 15%. This is again a negotiated number. These two are negotiated numbers, right? So when I'm raising, let's say you're going to an individual and you're saying that, hey, you know what, I need 1 crore. And the individual is saying that against that 1 crore, you have to give me back 1.3 crores. And how we will recover that 1.3 crores? By taking 15% revenue share. So what is going to happen is, let's say in month 1, you are making 10 lakh rupees of revenue. Okay. Out of this 10 lakh rupees of revenue, 1.5 lakh rupees will go to the investor who has given you 1 crore of funding through revenue-based financing, right? This every month will happen. So let's say in a month where the revenue has dropped, okay, where you've not been able to perform well, then the percentage of that dropped revenue will also be lower, right? So in this month, you've made 8 lakhs or 7 lakh rupees of revenue. You will end up sharing only 1.1 lakh rupees of that to the investor. But in the month in which you have made, let's say 27 lakh rupees of revenue, the share of the revenue to the investor will also go high. And this will continue until the cumulative number is 1.3 crores, until the total cumulative number achieved is 1.3 crores, right? So I took upfront 1 crore. I started using that money, and now I started generating revenue. And now after that, I've started sharing a certain percentage of that revenue back with the investor until a pre-agreed number is recovered on a monthly basis by summing up the cumulative numbers, right? Here, a moratorium period can be added. Let's say today you don't have revenue, right? You are going to take 1.5 years to develop the product, and after that you will start making revenue. So what you do, you take that 1 crore from the investor, you actually, don't give anything for a period of 1.5 years. And then as soon as the revenue starts kicking in, you start giving back a certain percentage of that revenue to the financer or to the investor. In this case, we are not giving a single share out to the investor in the company, right? We are not giving single share out to the financer in the company, right? It is purely, you can consider it as debt. But what's the difference between usual debt and this? Usual debt, your outflow on a monthly basis is fixed. It's like EMI. Whether you make revenue or no, I need 1.5 lakh rupees on a monthly basis. In this case, your outflow is actually assigned or is actually tied to a certain percentage of your revenue, right? There are a lot of investors that have come up and a lot of platforms like GetVantage, Recur, Club, Velocity, N+1. All of these are actually investing in the form of this revenue-based financing, right? Individuals are also investing in the form of revenue-based financing. The thing is, this is non-collateral based. So you don't have to give out any collateral, right? So I think Bala sir asked me question before for his company, what would be good? One of the ways that you can get is, let's say if you need 50 lakh rupees for the next 7 months and you will be able to develop technology and start monetizing in 7 months, take this 50 lakh rupees in the form of revenue-based financing and give a moratorium period or take a moratorium of 7 months. And after that, start sharing revenue on a monthly basis, right? What you need to be confident of is you will make revenue at some point in time, right? For if you say that, hey, I don't know, I'm developing the product. I don't know at what point in time will that product will be out in the market. I don't know whether I will make revenue or not. Then this is not the right approach. This is not the right way, right? This is not the right financing option for you. Example, one of the deals that we've done in this case is there was this SaaS platform that was getting created for hospitals, right? B2B startup was there. They were creating a product which will go as a SaaS platform for hospitals. So what they did was they raised a small round of equity for development of product, and then they never raised money for expansion because they have a flow of revenue. SaaS platform is monthly revenue, right? You have subscriptions. So specifically, if you are building a subscription-based model where the flow of revenue can be kind of a pattern can be developed, that I have 10 customers that I've acquired, and those 10 customers every month are going to give me, let's say 2 lakh rupees of revenue, then revenue-based financing can be actually an option once the subscriptions start kicking in, right? So this is one of the ways which you can actually use right now for, raising a round of capital. It can be structured with the, I would say, individuals. There are specialized platforms that can do this for you. And obviously you should do it. So a lot of startups at the incubation level, what they are doing is they're raising some money through the SISF. If you are less than 2 years old, you have a Startup India Seed Fund, which can give you up to 50 lakh rupees. There is the SSP, which gives you... Sorry? Hello? Someone was saying something? Okay, great. So at the incubator level, you can raise, you're raising money through these various schemes, and then you are topping up some operating expense through revenue-based financing so that you don't have to dilute a lot of capital, right? I'm going to take a pause here to see if you guys have any questions related to what we have discussed in this revenue-based financing method per se. Any thoughts, anyone? Any questions? Did you guys understand this particular approach of raising money? How can we do that? Am I audible?
You're perfectly audible. Absolutely fine. Okay. So any questions, please either put it in the chat or feel free to, whenever he is asking you, please do not hesitate to.
Yeah. So this particular type of financing, revenue-based financing, like I'm saying, is a very interesting way of funding startups, right? And we should actually, whenever there is an individual or whenever there is an investor that is coming to us and through these platforms, we should have these options in our mind that, hey, I don't want to dilute equity right now. I don't want people to come to on my cap table and interfere. But can I still raise money by offering this particular method? And all of these can be structured as convertibles. What do we mean by structured as convertibles? Let's say after 2 years or after 3 years, you have not been able to make money. Or let's say after 2 to 3 years, you have been able to raise another round at a much higher, at a very good valuation. Then you can always have an option to treat these instruments as convertibles. What is convertible? At that point in time, you can define whether you want to pay off, treat them as debt, or you want to treat them as equity and give some stake to these investors in your business per se, right? That is the way which we can actually use a convertible per se. Right?
I am Gopa. I have a question here.
Yes, please go ahead.
So, would this model suit a pre-revenue startup, or at least you need to have some amount of revenue before you can approach for this model?
Sure. So this model can suit a startup which is where monetization is visible. Okay. It may not be today, right away. Okay. Today, in the next 3 months, am I close to monetization? Right.
Okay.
So if it is in a situation where I am building the product, but I don't know how will I monetize it, or I don't know when will I monetize it, or I don't know how much time will it take to kind of develop the product, then this is not the right approach, right? But I'm very close to product development. I still need some amount of capital, and I have some orders, or I know that testing has happened and people are willing to pay for it. Then this is the right approach, right? So a company which is closer to monetization, I would put it, is actually a good way for a good candidate for this, right? And if you're already monetizing, right, if you already have recurring revenue, then though this is something which is very good for such businesses.
Yeah, understood. Thank you.
Right.
Hi, Vikrant. One follow-up here.
Yeah.
So generally, this revenue-based financing is more suited with individual investors, or is it also with the angel networks? And I'm not sure if VCs would work, but angel networks or individual investors we are talking about.
So it happens with individual investors, and there are specialized funds that are in the market today who are only doing it, right? So VCs are investing in the form of equity, right? There are platforms like, for example, this N+1 is a pure play revenue-based financing platform, right? Or there is a new platform that I recently met, Recur. Okay, the only thing that they do is revenue-based financing, right? So a usual VC is not the candidate for this. There are specialized players in the market today who are actually doing this revenue-based financing. And obviously, individuals, we can structure that deal with individuals, right? That is for us. If you, let's say, have an individual who's interested to invest, or a platform, angel platform comes and says that, hey, we are interested to invest. Can you invest in the form of revenue-based financing? Is how we can structure this now with them.
Got it. So in case if I am close to, say,
sorry, your voice is a bit muffled. Can you get closer to the mic?
No, in case if I am a bit closer to, say, product and getting customers, and I believe, and I think revenue-based financing would work. So how long should be my calculation with revenue-based financing? If my thought is always to reduce dilution, then I could take it as long as I can. So how do I calculate that? Up to what stage would revenue-based financing work?
Yeah. So your return expectation would increase if the time period is higher. Okay. The lower the time period in which you will be able to, give the money back, the lower the yield, or the lower the outflow from the founder's side, right? But if you're saying that, hey, you know what, I need 1 crore, I need 2 years of moratorium, and I need 4 years to kind of knock off that 1 crore, then the expectation from a return perspective would be higher, right? So that is how it will actually function. If I've answered your question, and if that was the question that you were asking.
Yeah. So if I can get it clear with one follow-up question. So these platforms which you mentioned, right? Who are these investors who are in these platforms, and is there any pattern of expected returns? Is only within 2 to 3 years you need to get the money back, or something like that?
Yeah. So typically, individuals or institutions, NBFCs, are the investors on these platforms.
Okay, and they have an expected money return policy.
Yeah. And in that, now the calculation matrix is also pretty clear. It is as simple as putting okay, the amount of money you need, the moratorium you need, the expected return, the percentage revenue, basis that it gets calculated. But typically the yield is somewhere between 2 to 24%. That is the kind of, in a way, return that you will be giving to the financiers.
Got it. So how do they assess it, and who assesses in case if we go to these platforms?
Typically, the platform has a mechanism to assess it. In case of individual investors, here the assessment is more on the business model. So this is like in pure play debt, collateral, operating history, numbers are assessed, right? In this case, the bet is more on the business model. So imagine assessment is like VC, but the instrument or the financing option which is given is like debt, right? That's the theme.
Got it. Okay. Sure. Yeah. Thanks.
Any more questions on this? Great. So the next is possibly the next way of financing is possibly a question which I get almost every now and then is basically what is crowdfunding, right? And how do I raise money in the form of crowdfunding? What I'm going to do is we will take it's 1 hour. We will take a quick 2-minute break, like a very quick 2-minute break. Maybe you can grab some water or chai. And it's 12:10. Maybe at 12:12 we will come back. I'm also going to take a quick 2-minute break, and then we will move on to understanding how do we raise money through some of the other ways, alternate ways, and one of that ways is crowdfunding. So let's come back immediately, very quickly in 2 minutes. Is that good? Great. So the next the next source of capital that we are going to look at is crowdfunding, right? And crowdfunding is possibly the most democratic way of raising capital, okay? And there are various ways of crowdfunding. What are the various ways of crowdfunding? One of the ways for crowdfunding is equity-based, okay? Where you are raising money and you are offering equity to the investors, right? The other way of crowdfunding is reward-based, which means you are raising money for developing a product, and then people who are actually giving you money, you are giving a small reward to them, right? And third is a pure...
Tell me.
Hello? Yeah, the third way is...
Probably till 12:30. 10 to 12:30.
Yeah. The third way...
Give me a minute. Let me check my calendar here. I mean, you can do without me, no? Or do you need me?
1 second, Vikrant. I'll tell Professor.
For me, tomorrow...
Yeah, now we can go ahead.
Great.
Yeah.
The third way is actually a donation-based, which we are seeing a lot in India where, let's say a child is unwell, needs to undergo an immediate surgery, and money is required for that, right? So that is what we call as donation-based. It is interesting to actually note that typically equity-based financing in India as an option is not available, right? We are not allowed, the regulation is such that we are not allowed to raise money through crowdfunding against equity, because what SEBI says is basically it is like you're actually doing an IPO, right? You're going to large base of customers, you're going to large base of investors, and you're actually giving equity out against small amounts that you are collecting, right? So in India, equity-based crowdfunding actually is not allowed, right? The only way in which we can raise money for crowdfunding for startups is actually reward-based, because we are not an NGO, we are not actually raising money in the form of donations, right? So a lot of startups today are actually raising money for developing their products through crowdfunding platforms by giving them some way, maybe what they are doing is they are taking pre-orders of the product by taking money first and then giving the product as the reward itself, right? So let's say if your contribution is 100 rupees, you are giving some free workshop. your contribution is 1,000 rupees, you're actually giving some product samples and so on and so forth, right? So how does this work for startups? How does this actually crowdfunding works for startups, and how as startups we can raise money? I'm going to give you an example of this particular company that raised money through crowdfunding, which is called Square Off, right? So what is this Square Off company? This is basically a chessboard. It's a smart chessboard where basically the chessboard is playing chess with you, right? So you don't need anyone, any opponent. You are playing chess, and there's the chessboard itself is playing chess with you, right? So the product itself looks very, very innovative. And this company raised 1.63 crores from 779 people through crowdfunding on a platform called Kickstarter, right? So what they were able to do is they were able to actually raise this 1.63 crores from a bunch of people on a crowdfunding platform, right? How did they do this? What were the steps? So the steps were that first, if you want to do this, okay, you actually have to have a very strong network of yourself already, and you need to have a very viral product per se, right? So imagine this chessboard, which is playing chess with you without any opponent, right? You don't need any opponent. The chessboard is playing chess with you on its own, right? When they launched their crowdfunding platform, when they launched their crowdfunding campaign, they already had around 8,000 people following their page. During the product development stage itself, they had created such a big, viral element of their product that people were very intrigued to know about the product, that, hey, you know what, this looks very, very interesting, right? So they already had their own network of people, their own likes on Facebook, and their own, virality, which was built into the platform, right? They had done their research, and what they did was they chose Kickstarter as a platform for actually raising crowdfunding, right? So you have various platforms, typically for technology products. Okay, if you have very, very good, if you are high on innovation, then Kickstarter is actually the platform on which you can raise money, right? So they chose, you have to build a campaign on a technology platform. And in their case, they built the entire campaign on Kickstarter as a platform, right? Now, what they did after you choose the platform, you have to actually select the reward that, okay, if someone is giving me X amount for my startup, against that, what reward am I going to do? What reward am I going to give? How do I deliver that reward back to the backers, right? What is the amount of budget that I need to assign for campaigns, right? And what is the commission that the platform is going to make? Typically, the platform makes 5 to 10% of commissions, right? So against that also, you need to create a very strong looking video. You need to have a great description of your product. You need to put out details of your team. What are you going to do after you raise this money? What are the various reward levels? All of that needs to be uploaded on the platform per se when you are actually initiating the crowdfunding campaign, right? So in this case, let's say things like, why do we need the funding for? So let's say February, I needed funding for proof of concept. I actually made the 3rd prototype. Now I am in the 5th prototype stage. This is where I am on the timeline perspective. So very detailed information is given on these crowdfunding platforms on why do you need money, by when will the product be delivered, by when will the product be ready, and what are the rewards that you are actually giving to the backers per se, right? So this is what is extremely critical for you to actually put out in the crowdfunding platform, right? What crowdfunding gives you an advantage is that once the idea validation is done and the customers come to your platform, comes to your product or service through this crowdfunding, it becomes a public spectacle, right? So what happened was when this particular company launched their crowdfunding campaign, almost 2,000 pre-orders is what they got through 70 plus countries. They said that, hey, we are building a product, this chess board, which will play chess with itself. And now we want money for development of that. What they actually got in return was 2,000 pre-orders from 70 plus countries, right? And the success of this crowdfunding campaign paved the way for raising VC money for them. Because they successfully were able to raise money through crowdfunding, India Quotient and K-Start looked at them and they invested additional 11.5 crores because they got a lot of PR. They invested additional 11.5 crores in the form of equity in this particular company per se, right? So in crowdfunding, what you are doing, you are actually, funding your innovation through backers, and against the money that they are giving you, you are actually giving them your product, or you are actually giving them some reward, right? And through that, you are collecting that money and using that money for development of the product per se. Because of that, you are getting a lot of visibility. And because of that, it paves way for actually raising money from VC investors as well, right? So if you see most of the electric bike products in the US, electric bikes, the way to launch electric bikes in the US, if you see, is to put them up on crowdfunding, right? So what happens is I need money to produce 100 bikes, okay? And that is why I am on the crowdfunding platform. You will be able to raise money for producing these 100 bikes by taking money from these customers per se in advance. And then you are working on it and then you are delivering, right? And the success of that, crowdfunding campaign at times also determines whether you are able to actually raise a round of capital or not from VCs as well in future, right? What is important here is, you need to have a very innovative product to gain that virality, right? I would say, like someone is mentioning, Nitish is mentioning, it's good for B2C hardware products. Yes, you are actually right. I would not put it B2B, B2C, but it has to be really, really innovative, or it has to kind of serve a particular cause, or it has to kind of, strike that chord with the backers. And then you will be able to actually, create a successful crowdfunding campaign and raise money through crowdfunding, right? I'm going to take a quick pause here before, so that I can take some questions in terms of, are there any questions related to this particular method? So on this method, we have Revati is asking, will this crowdfunding work for B2B products as well? It can work for B2B products as well, right? For example, like one of you mentioned, there is a technology which you are creating for cancer, let's say, right? Now this may actually strike a chord with, and the application may be B2B, but the need would be so strong, and it can actually create that virality that maybe crowdfunding can be an option for this particular B2B product as well, right? B2C, definitely yes. Like I mentioned, especially the electric two-wheeler segment got such a great push because of the crowdfunding platforms across the country, especially in the US, right? That is what we will have to look at. Any more questions on this? Any more ideas? So this used to be always a question that used to come to me, and people believe that crowdfunding can be used for giving out equity. But today, like I said, in India, crowdfunding through equity is not allowed. We can't use that. We can use crowdfunding only for reward or for donations. So for startups, because we are not NGOs, the donation based is gone. We then raise money through crowdfunding for rewards per se, right? Vani is asking, do you handhold startups on crowdfunding? To be very frank, Vani, handholding is not required. These platforms, if you go right, Kickstarter, etc., you will figure out they have created such good material that you will be able to kind of, understand it very easily. Try and understand one thing on crowdfunding. If you want to raise money, some bit of marketing from your side will also have to happen. Some bit of push from your side will also have to happen. Creation of community will also have to happen. It is not as simple as just putting it out on the crowdfunding platform and people will subscribe, discover and subscribe. That doesn't happen typically, usually, right? You also have to, through your network, push that, hey, you know what, this is what I'm actually doing, right? So that is something which we will have to figure out. It is not as easy as just putting the campaign out on the platform per se. like a good quality video which talks about the product, the founder coming out and talking about what the vision is, showcasing the product, more and more material like that will have to be churned out.
Yeah, I saw the Kickstarter profile and I was looking at what they had. It's really exciting. It looks exciting. Unfortunately, like it is for I'm from an animal healthcare startup, and like it is the case with most funds or any platforms that we go to for any kind of consulting or otherwise, animal healthcare never comes up. It's always healthcare, tech, IoT devices. You get all kinds of drop downs except for animal healthcare. Why crowdfunding looks like a very exciting opportunity for us is it's also because we're doing this to begin with the dog populace. We have a healthcare tech device. We seem to be ticking all the boxes from the start of your presentation, because we want to do manufacturing. We have to deliver the product before we can deliver traction. We do have healthcare through the year subscription model. So we tend to be ticking all the boxes, but this seems to be really exciting because I know when we say dogs, there is a whole community which probably will come up and support. So it seems like a very exciting marketing opportunity. So I mean, it's been very cool so far. Thank you so much, Vikrant. It's been very eye-opening. It's been a brilliant thing. Thank you. Yeah.
Sounds good. What are the rewards that typically give out? For example, chess startup, when people gave them. So what they did was they created a pawn out of, they created actually, that king out of rosewood, right? And they gifted that for people who had given lesser money. They actually gave out the entire, see, if you are getting money which is equal or more to the price of the product itself, then what you are doing is you are actually getting money from the customers first, creating the product and giving out the product, right? So you are getting the funding for the product done previously, right? So in this case, they had various reward levels, right from those rosewood, kings to the chessboard itself, right? And if you go to these Kickstarters, Indigo Edge, especially some of these US crowdfunding platforms, you will get a sense, what kind of rewards do they give out, and so on and so forth. So that's the thing. So almost around 800 investors contributed to that 1.2, 1.3 crores of funding through this particular, exercise, right? Great. Moving on to some of the short-term obligations, and it's almost 12:30. Very quickly, short-term obligations. What do I mean by short-term obligations? Short-term obligations is that I have raised an invoice. Okay, I've raised an invoice of 2 lakh rupees, let's say, but the money is not going to come upfront. The money is going to come after 90 days, after 120 days. But till then, I want to use that money. Till then, I want money for paying off my salaries. I want money for actually operating my expenses, right? Day-to-day expenses, right? So this becomes short-term obligations. Now for short-term obligations, let's say you've raised an invoice of 30 lakhs, but you will get it cleared in 90 days. So what is happening? Your 30 lakhs is stuck for a period of 90 days. But I need the money as soon as possible. If possible, I want the money today itself, right? Because I want to take care of expenses. So here, there is a concept called bill discounting. What is bill discounting? That you were supposed to get 90 lakhs, 30 lakhs after 90 days. Can I give you 27 lakhs today itself? And as soon as the 30 lakh invoice gets cleared, I, as a financer of 27 lakhs, will take that entire 30 lakhs to myself, thereby making a 3 lakh rupee profit for myself, right? So what I'm going to do is, I am, as a founder, I am actually letting go of that 2-3 lakh rupees so that I can get money today, right? And the financer is financing me so that he or she can make that 2-3 lakh rupees over a period of 90 days, right? This is typically called as bill discounting, right? And there are platforms. So if you are a startup which is revenue generating, where you are facing a challenge of working capital, right? Where, hey, invoices are sent, money doesn't come on time, and I need money only for keeping it rolling, right? To keep it rolling, to keep the business running. Then there are platforms like Grip, Giraffe, Credex. All of these only work on bill discount. You put an invoice up, you get the money instantly, and then whoever is paying that invoice, that total amount of invoice, right? This is how working capital facilities of banks also work, right? Now, a lot of banks are focusing big time on startup as an ecosystem as a whole, right? And they're coming up with a lot of products specifically for startups, which are catering to startups. So one of the products that they are offering is basically a non-collateralized working capital facility for businesses. What it does is it gives us that rolling money. It gives us that money sooner, which we can invest in growth rather than waiting for a period of 90 days, 60 days, etc. Right? So the best way to actually cater to our needs of short-term financing is either check with your bank that can I get a small working capital facility? Most of the banks will give you today. And second is check on platforms like these where can you take advantage of bill discounting, right? And that is something which we can actually look at as well, right? To kind of summarize, and I'm going to leave some time now for questions or discussions, right? To summarize this entire thing, okay, these are the options overall that are available for us, right? There is venture capital, there is debt, there is revenue-based financing, there is crowdfunding, there is something called as venture debt. I'm not going to double click on this. A lot of reading material on that. I will also share my videos on venture debt with you guys. And then there is bill discounting, and then there is overdraft, which is the working capital facility that I spoke about as last point when it comes to banks giving it to them, right? A mix of these or all these options are available to us. I think the bigger question, the bigger point is knowledge arbitrage, right? We have not explored all of these options. After this, basically start thinking on these lines that can I explore these options? Can I check with my bank that can I get some facility? Can I actually explore some of the revenue-based financing platforms? Can I actually go to some crowdfunding platforms? And obviously venture capital and individual investors, incubators, those options are available to us, right? So I always say this, that last calendar year, okay, if in 2022, the total amount of capital that went towards early stage, financing early stage was $24 billion, okay? I'm not talking about the money that went towards, large companies, listed companies. The amount of capital that only went to businesses like you and I run was $24 billion. And last year was not the best of the years. Now, if I divide that $24 billion, if I convert that into INR, and if I split it, that comes somewhere around 3,600 crore rupees on a weekly basis, which means almost 600 crore rupees on a daily basis. What am I trying to say here? Last year in India, 600 crore rupees on a daily basis went towards financing businesses like what you and I are running, right? The total amount of money that went into businesses like what you and I are running on a daily basis, that was 600 crores. If I was not able to raise 1 crore out of that in the entire year, then the only reason why I've not been able to do that is there is knowledge arbitrage. We don't know how to do it, right? And therefore, for the lack of better words, I'm not being sexist here, just for the lack of better words, what differentiates men from boys or girls from women in this entire game of financing or fundraising is very small thing, knowing how to raise a round of capital, right? People who have raised money were able to raise money at times not because their businesses were really good, but because of a simple thing, they knew how to raise capital, right? And our objective has to be that every day, 50 minutes, 1 hour, can I dedicate to only exploring that, boss, how do I raise money? Which option should I explore? Can I talk to this guy? Can I talk to the bank? Can I talk to the incubator? Can I talk to one VC? Get him. As much as you gain inputs on that, it will be important. As business owners, finance is something which we cannot ignore, right? I mean, a lot of times entrepreneurs come and tell me that, hey, you know what, I come from the technology background. I don't have understanding of that. the fact that you've entered into business, you don't have an option but to learn, understand, know finance, right? Because that is going to be game changer at some point in time. Every time when we want to take the next step, right, and scale, your bottleneck is going to be finance. And understanding how to raise that through various options is going to be key. Obviously, this 1 hour, 2 hour session is not going to be enough. We have to keep doing this, keep discussing this, keep talking to people, keep reaching out to people. And that is how at the end of the day, we are able to raise a round of capital, whether it is in the form of equity, debt, crowdfunding, whatever it is, right? So just a quick summary of the entire session. Venture capital, guys, is expansion purely driven by front loading of costs. Debt, when we want to create physical assets. Revenue-based financing, when we have line of sight or stickiness of customers, subscription, annuity, these kind of businesses, great. Crowdfunding, product that has a wow factor, can be made viral. And bill discounting, if you have good clients, you're raising invoices, but invoices will not get cleared immediately, then explore bill discounting or overdraft facility. From the content standpoint, that's it from my side. If we have any questions, any thoughts related to what we have discussed so far, happy to address, happy to discuss with you guys. And over to you now for any questions, thoughts, etc.
Hey, hi, Vikrant. Could you brief me about that overdrafting, which I missed, I guess?
So overdraft is nothing but, a bank, okay? A bank actually gives you a certain limit, okay? Let's say your balance, today your balance in your bank is, let's say 1 lakh rupees, okay? A bank will actually give you an ability to make that balance as minus 5 lakh rupees. It can go up to minus 5 lakh rupees, right? It is like a credit card given to the business, okay? Where you can, even though you have 0 rupees in your, 0 rupees in your account, right? You can go down up to minus 5 lakh rupees, where 5 lakh rupees is the overdraft or the working capital or the CC limit given, right? That you get it depending on obviously your, relation with the bank, the schemes that they have, and so on and so forth. On that, the moment you start getting positive, you start getting money in the account, your account starts, the balance starts becoming positive, and ultimately it reaches 0 and then goes above 0, right? So an overdraft is nothing but ability for a business to have negative balance up to a certain level.
Got it.
Right?
Yeah.
So let's say on 30th of the month, my revenue, I had made revenue, invoices have been cleared, invoices have been sent, but money has not been cleared. But I need to pay salaries. So my account balance is 0. Do I need to wait for 5 days? No, I can pay salaries by making my account balance as minus 5 lakhs, right? That is how it is.
Okay, so does that mean, okay, I can get an extra 5 lakh from the bank?
9. You can always get, and as you kind of, repay that, the limit again comes back to you. So let's say I get invoice, I get 10 lakh rupees, my balance is positive 5 lakhs. Now I can spend 10 lakh up to 10 lakh, right?
Got it. Mm-hmm.
That is how it works.
So just a quick add-on comment to this, Karthik and others.
Yes, bro.
Today, as you know, State Bank has opened an account, a branch inside Research Park, right? Mm-hmm. So they may look at this a little bit more favorably, but most banks will give you overdraft, but they will want to take a very serious look at your, inventory. And many times the overdraft is given based on your inventory, the stock that you're holding, or various other things. So it is a seriously tedious process. But maybe the State Bank, which is a startup branch that opened in the Research Park, might have a slightly simpler way of handling it.
Absolutely.
Okay.
So a lot of these startup focused. So for example, my business does not have a single asset, single inventory, anything. Okay. But I have an overdraft facility of almost like 15 lakh rupees, right? So what does it mean? That, and it's non-collateral, right? I have not put any collateral. I have not given any collateral against that. It's purely relationship, and it's purely a focused division that is supporting certain businesses, right? That needs to be you need to find the right, I would say, bank, and like sir mentioned, that way, right? So things, I will tell you something, things in the banking industry are changing at such a fast pace, and all banks are very, very now openly looking at addressing the challenges of startups, right? Earlier, I had to, for the same working capital facility, I had to put some collateral, or I had to kind of, give some guarantee and things like that. Today, I am a business that has no assets at all. I am a business that is not into, I'm a pure service business. And yet I have a working capital or a CC facility, right? Purely driven by a relationship person, right? That's how, it works.
Got it. Got it. Makes sense. Sure.
A quick
Thanks.
follow-up question on the other category that you talked about, bill discounting. I'm so sorry, I probably missed a little bit of that because I had to take a phone call.
No problem.
I'm just checking. See, banks used to do a lot of bill discounting many years ago. Of late, it is almost not possible through banks.
Yeah.
So, what sort of an organization will do bill discounting? At least the traditional banks don't do it. Your state banks and the Canara banks and all are not doing it. We've tried it.
Yeah.
Even though you have a very good relationship with them.
Yeah.
So, are there others? Okay.
Yes.
And what is the approximate interest rate they charge?
Sure. So what has happened is specialized platforms, startups have come up who are actually facilitating bill discount. Example, there's a startup called Grip, Giraffe, ThreadX, Recur. Now, all these guys are actually facilitating bill discounting without banks getting into it, even through individual investors. So today, on something like a Giraffe, for example, I, as an individual investor, can also finance a bill discounting deal, right? So these platforms have come up and they are actually facilitating bill discounting. The rates, again, the IRRs are anywhere between 18% to 24%, depending upon obviously the strength of the invoice. Obviously the better the brand, the lower the interest, and more possibility for you to raise money against that, right? So now I think what has happened is in crowdfunding, in bill discounting, in revenue-based financing, startups have come over and have built platforms that are facilitating other startups to raise money through these channels first, right? So, anyone who wants to explore these platforms like Giraffe or Grape or CredX, where you will be able to actually figure out how can you raise money through this from these platforms, right?
Got it. Okay. So, but the interest rates are 18% plus
are high,
is what you're talking.
High.
Yeah, much higher, right?
Yeah, are much higher because of the risk related to the startups which are there.
But if that is the case, probably would NBFCs also be and private parties will also there are enough possibilities at those interest rates, correct?
Yeah. So what happens is with larger NBFCs, the ticket size becomes a problem. Let's say I have a bill of 10 lakh rupees, which I want to get it cleared. Then a lot of times for larger NBFCs, this becomes a very small transaction. So maybe I will check, but maybe there are a lot of NBFCs now that would have started looking at startups and smaller bills also, right? But yeah, it is, people are exploring this option, and it's very new per se, but it is catching up for sure.
Okay, terrific. So this is news to me. So maybe this is an option, because one thing for the people who are in the audience, this is not for long term. These are for short term. So you're talking of, just because you have to deliver something or you are short of cash, you need for 2 months, 3 months, and eventually you'll get paid. So although the higher interest rates are, a little scary, but it's not for very long term. So it helps you pull over, and then hopefully that will be built into your business model.
Yeah.
So
Yeah.
So always, whenever you're bidding anything, please understand there is a cost of financing that very few people think about it. You only do bill of materials, maybe labor at best, maybe rent, but then you never ever think about cost of money. Okay. That is something you have to figure into your calculations when you bid for any projects or any, costing.
Absolutely.
Prof, could you just, since you mentioned that point, could you brief that a little bit, or any problems that you have faced with not calculating cost of financing?
We face it every day, every day in multiple places. So, cash flow is the biggest challenge that most successful companies have. Okay, and often that is where the problem is, and this is a little bit more serious in India, because whether it's government or private customers, the payment cycles are A, longer, B, unpredictable. Okay, and I give an example. Let us say there's a company X that you have supplied something. All right, in India, you have very limited options if the guy delays your payment by, say, 6 months or 3 months. The point is that if you get paid 3 months later, then you have to calculate the interest on that. So let's say 100 rupees is what they owe you. Okay, you have to calculate the interest at least 12 to 15%. All right. So 3 months the guy takes away. That means you lost about 10 to 12 rupees on this order already. Okay.
True. Yeah.
So you have to understand what is the payment cycle and what is the track record, if you can find the information, and you can do that by just some calling around other clients who have been dealing with that particular client, and then you have to go back and figure that into your cost. Now that is all good in paper. Now, depending upon competition, sometimes what can happen is that you may want to charge the guy 100 rupees, but due to competition, you may be able to charge only 80 rupees. Okay. So there is a phenomenal issue with regards to the cost of doing business because of the unpredictability of payment. Okay. Now this people think that it's only government. Most VCs think it's only B2G, but I've seen B2B also having similar issues. In fact, I would say at least I'm guaranteed of payment from B2G. With B2B, you are not fully guaranteed. Nobody is guaranteeing you that. So that's another big problem that we have. And so you have to figure it into your business model, whether you like it or not. All right. So as much as possible, whenever you put your costing, you have to put certain percentages depending upon your billing cycle. So most billing cycles are net 30, net 60, net 90, or net 120. Okay, many of us will agree for a net 80, 90, or a net 60. Okay, the problem is that 60 days you're not getting paid. Okay, while you have delivered your product, which means that whatever interest you are losing on that is something is your loss to you. So that needs to be accounted for. So you have to make sure that that is built into your original cost model. Okay, so that is net 60. Now the guy may not pay at net 60. He may take another 20 days or 30 days to pay you that. That is the unpredictability that happens. In India, you have no choice. If the company X does not pay you, you can't. If you take to court, that will take, I don't know, or arbitration or anything. That takes years sometimes. And at the end of the day, you wind up hurting your business, and you are distracted. So many companies just endure today. Now, this is not a case in many other countries where any default beyond the net, whatever terms, is often considered as equal to check bounce in India. Okay. And so most of them will pay bang on that date. They'll not pay one day before, but they'll not pay one day later either. They'll pay pretty much on that day, plus minus 1 day maximum. Okay. So that is the uncertainty in India you'll have. Okay. which you have to account for. I think Vikrant can probably add much more to it than I do.
Yeah. You're absolutely right. And, so working capital is a very, I would say, is the most, founders need to work and focus on this topic a lot. It's the most, I would say, neglected, but most important topic in entrepreneurial finance, I would put it. Right. Most of the times when we see the fundraise requirement, it is actually not expansion, it is actually working capital, right? So yes, it's important to consider that.
Got it.
Great. Any questions?
Thanks.
Okay. So if there are no more questions, then I would like to close today's session. Thank you so much for. It was a Monday morning, and I understand for all of us as entrepreneurs, it is possibly the most busy day. And on that day, everyone came and attended and patiently heard me. Thank you so much. And thank you, sir, for giving me an opportunity to.
Our pleasure. It's our pleasure, Rahul, and you. Thank you so much for making this happen. Also, if you don't mind, can you just put your email ID in the chat box so that if anybody needs any follow-up questions, and I think somebody wanted to even chat with you, all right, they can go ahead and do that. So I think it is available, you can see it right there in the chat box. So please do take note of that. Also take note of that article that was forwarded in your story by him on why you should be careful when you start, going for a certain VC type funding, equity funding. All right. But I think this gives you a reasonably good picture of the different forms of non-equity based funding that you can have access to. So what we'll do is we first want to thank both of them and thank BSc Institute for hosting or helping us with this particular talk, because this is something that I wanted people to hear. And I believe this is very important that there are alternatives. No alternative is easy. People don't mind pitching to 45 different VCs each 2-3 times. But when they want to go to the bank for a loan or something, they feel that the second or third attempt itself is a big chore. Okay, so trust me that no money comes easy. And with every money that you take, there is significant responsibility and accountability that you will be facing from the investors or the person who are giving you the money, as well as the government of India. Okay, so always do not take money which you don't need it, but plan for alternatives, because the dynamics of your business is often extremely unpredictable. So with that, I would like to again thank BSc Institute. I would like to thank Vikrant. I would like to thank Rahul, Randeep. All of you, thank you. We hope to have you over here for a longer session, maybe a 2-day session, if that works for everybody. All right. And maybe, a part of it can be one-on-one with individual, groups. And definitely we welcome you to our ecosystem. We would love to show you around.
Thank you.
Thank you, sir.
Thank you, Vikrant.
Thank you, sir,
And
for giving us this opportunity.
Yeah, thank you very much. Thank you.
And have a great evening. Charles, any closing remarks from Incubation, sir?
You can do, Prof. I think you can thank Vikrant.
Thank you all. Thank you all.
Thank
Okay.
you.
All right.
Thank
have
you.
a great day. Great evening, all of you. Great
Thank you,
afternoon.
Professor.
Sure.
Thank you, Professor.
Bye. Bye.
Thank you, Professor, for organizing this.
Yeah, sure.
Thank you so much.
Thank you so much.
Bye, bro. Yeah. Bye, Vikrant. Thanks.
Bye. Bye.